Okay.
Hi, I'm Debbie Lucci from the Deborah Lucci team, William Ravis Realtors, and we are a group of realtors that's north of Boston is our main selling area. And I'm just happy to announce that we were the number one agents for William Ravis in the entire state of Massachusetts. And I'd like to introduce some of my team members, Mackenzie Cormier, and also Nicole Leahy. And Nicole Leahy just got voted out of the top 50 in Massachusetts for an award for Best Social Media. And then we have a guest here, Robert Flynn. He is with William Ravies Mortgage. And we're going to talk today about some of the products that William Ravis has regarding mortgages and how this can help you as a seller and move to the next house. So, ladies, do you have any questions for Bob?
I mean, about a million of them, yeah.
Okay. All right, Bob. So, describe some of the products that you have that are new from Ravis and how we can help sellers.
Yeah. So, thank you for having me on today, Deb and team. So the biggest problem we obviously have in the marketplace today is inventory, right? Or lack of inventory.
Right.
30 buyers for each home. People are making offers, well over asking price. And it's difficult to be able to compete if you have a home to sell. It's a kiss of death to try to make an offer with a sales contingency. So most buyers don't realize what they don't realize. So Ravis has come up with products to help those buyers. So whether it's a bridge loan, whether it's a first and second where we carry a HELOC on a property and then pay off the equity once we sell the trailing home, or we have something really exciting, which is a purchase program, which we will actually purchase a seller's home, give them up to 80% of their equity, pay off their existing mortgage, so they can then go ahead and make an offer with a non-contingent sale because literally they've sold it, or not close on that program and give them an opportunity to sell their home prior to buying their own new home. So it allows them to compete in the marketplace without a sales contingency.
Okay, so let's do a couple of scenarios here. Let's say I have a house and the house is about let's say it's like a $700,000 house. All right, so you would give 80%. You'd buy the house and give them 80% money to play with to buy the new house.
Correct.
Okay. All right. Now you said the other option.
So what happens is that most people, again, without the ability to carry two mortgages and make an offer without having that sales contingency, that death kiss, will need a type of bridge loan or the sales program that we offer in order to qualify, right? The key is qualifying because bridge loans still require us to carry mortgages. It's just less of a debt in order to bridge the gap between the two. And that's due to the 2007 and 8 housing crisis, right? The government came up with rules and regulations, something called QM, qualified mortgages, and we have to fit the square, peg into the square hole. With the purchase program, we eliminate that debt for the buyer seller, and we actually won't close on that until the day before they're closing on their new property. So ideally, a client wants to sell their property, right? Take their proceeds, move along. This program allows them to do it if they haven't sold their home. Now, the other nice thing about this program is we can couple it with something called Ravis Refresh, where we actually will give the clients the monies to fix up their property. So it's a win-win-win where they can turn around and move to their new home. They can actually spruce up the trailing home and then sell it for more money post-closing. Once that sells, we give them the rest of their equity and they're good moving along.
I just have to give a plug for the company that does a lot of work with the Ravies Refresh. We had a house and they worked on it, I think, about 8 weeks. And we put it on the market last week for $929. And we ended up getting multiple offers, 14. We got 14 offers on this property, and it actually sold $145,000 higher than what we listed it for.
That's
So,
wonderful.
yeah, Ravies Refresh, those people that did that did a great job. So, the seller got more than his money back for the project.
Sure. And
Yeah.
that's the key, right? To
Mhm.
you put in 60 and you get 100,
Right.
and you're not doing the work. And it's just wonderful to be able to have the ability to do that, nor are you footing the bill. So, it's a very exciting program that we offer. And again, it's ways that we can help buyers to bridge the gap. And that's going to help us on the listing side too, right? Because they're
Right.
going to be listing their home. It's going to increase inventory and help throughout the Massachusetts market that we have.
Yeah, I think that's one of the biggest obstacles when I go out. People are like, but I have to sell to buy. How am I going to do this? I'm afraid I won't find anything. And they get really nervous because the inventory is so tight. So this is a nice product. So it is.
And Deb, one of the things that people, I'm fond of saying people don't know what they don't know. So a lot of times people think they need to sell to buy, and they actually don't. Out of the 10, let's say 10 clients that call me for a bridge loan, once I actually put together their puzzle pieces, which I can do real quick because I've been doing this for over 30 years, we find out ways that they can actually move forward without using a bridge loan. So there's no extra fees involved, and that they actually can carry both properties. And the key is sometimes just getting enough of a down payment in order to bridge the gap, because it's usually an asset piece that becomes a problem. And people don't realize that they can borrow, $50,000 or 50% of their 401ks. I'm not talking about liquidating where they're going to have a penalty or a tax event. It's just borrowing it. People can borrow their own money, pay themselves back the interest that's charged. So it doesn't go to a bank, it goes back to them. It just comes out of the markets and they're paying themselves interest on that money. As soon as they sell their trailing home, they pay it back. We also can put a HELOC, a home equity line of credit, on the new home, so that when the dust settles, we have a client that basically is not having to refinance to get the equity from the old home into the new home, because we just do 2 mortgages. So we kind of back trail what we want to do, where we want to end up once everything's settled, all homes are sold. And then they have a home equity line of credit on their new property. If it's a zero balance, there's no payment, they get a checkbook, they can use it for up to 10 years. And it's just a great strategy. So there's other ways of doing it other than bridge loans or sales too.
All right. So explain how this HELOC works.
Yeah. So
Sorry, Nicole.
Yeah, a home equity line of credit is in the monthly adjustable tied to prime. They are.
But you're buying this. You're going to get a HELOC on the new house.
That's correct. So let's say, because what happens is once you sell your trailing home, or once you say you're going to sell your trailing home, and for within a 2-year period, banks don't like to lend on it, right? So you can't go to get a HELOC on your existing home if you're planning on selling it. It's one of the questions they ask immediately. So what we would do it is on the new home. So I'll give you just an example. Somebody's got $1 million home that they're selling, and they owe $600 on it. So they have $400,000 in equity. As long as we buy the new home, let's say it's just an identical strategic move, and it's $1 million on the new home. As long as we can do a 10% down out of their pocket, so they both have a 401k, we get $50,000 from the husband and wife. We have our $100,000. Once they sell and then what we do is we'll do a $600 first mortgage, a $300,000 HELOC on the new home, so that when they sell the trailing home and take their $400,000 equity off, they just pay down their equity line, that HELOC. They pay back themselves their 401k money, and they're left with their $600,000 mortgage with a $300,000 open line of credit that they can use into the future.
Now, So all this would be done, and it would be implemented when the new house closes.
That is correct.
Now, see, that's funny because what my understanding was, and I'm not in the mortgage business, but like if they took a HELOC out on their old home, the old house can't be on the market.
That is correct.
All right, so this is huge that you can do this.
I do these all the time. A lot, I have maybe 15 going right now for my clients. Yeah, and again, clients don't know what they don't know. Now we have to have the income to support carrying everything for the short period of time. But most lenders, including our jumbo investors, and jumbos are portfolios, so they have their own overlays and rules and regulations, but most of them will do it. If they have their trailing home under agreement with no conditions for that buyer of theirs, they will forgive that payment too. So that's also helpful to help someone bridge the gap. So even though it hasn't closed yet, they can buy their new home and not have to count that trailing payment if they have a conditional commitment. And the way things are going these days is, things are selling immediately.
So ladies, you have any questions for Bob?
Yeah,
I'm
Bob,
sorry?
I just can you go over the basics of a bridge loan?
Yeah, so there's a variety of bridge loan types, right? Some will allow the client they take the amount of money, a percentage of the equity, sort of like the purchase program. They'll actually take the payments out from that client for 12 months, and they'll lend the new mortgage and then forgive that debt when they when they sell the trailing home. Now the problem, not a problem, because it's great to have the ability to do it, is that it doesn't come cheap. So you're paying above market rates for a bridge loan and sometimes fees, in the terms of points. So what we always try to do is we try to help our clients to do it the most cost-effective way we can, depending on their scenario and situation.
Okay.
Okay, does that make sense?
What are you seeing people do the most of?
Whatever works for them. We take them through their puzzle. I can put a puzzle together in minutes for clients. It's not much I haven't seen, although I'm still surprised. And the market changes, right? Things change with Fannie Mae and Freddie Mac. We get changes every day. They change their guidelines, their rules, our jumbo investors. So just a little basic for our other audience members that are listening is, the United States is a level bathtub when it comes to loans, right? Conventional loans, which are Fannie Mae and Freddie Mac, they're in government receivership, but they have their own rules and regulations. So throughout the continental United States, it's 548,250, 548,250. Okay, so that's the max loan amount for Fannie Mae and Freddie Mac. If you're above that, you have to go jumbo. And those jumbo loans are portfolio or privately held by big institutions, local banks, large banks that lend, and they usually charge a fee for that over and above what conventional loan limits are. Now, after the housing crisis, when Fannie basically stopped lending and local banks just shut their doors, as we all know, the government, rightly so, created a high balance type of loan. So something that's over and above what those conventional loan limits are in certain counties in the United States. In Massachusetts, we have 5 of those counties that allow us to go up to $724,000. And the Cape and not the Cape, but the islands are actually much higher than that. They're in the 8s. So it's nice for those clients because with a conventional loan, you can put as little as 3% down for the true conventional, and the high balance loans, you can put 5% down. Jumbos usually require 20% down, those portfolio loans, although I do have some of our investors that allow 10% up to $1 million for the right type of client, high FICO scores and things like that. So it's important to understand that there are different levels of programs out there. In Massachusetts, in our communities, especially yours, we have the ability to go up to 724 with 5% down. It's wonderful.
Wow, that's unbelievable. You know, one of the things that we were kind of talking about a little bit of, one of the good things about this is the house in the house actually, if you want the house to test the market to see how high you can get for a price, these programs enable that.
That is correct. That especially in these communities where, if you're in Bristol County, where I live in northeastern Massachusetts, we're limited to that 524, 250. So if somebody wants to buy something and finance it at 600, the only option is a jumbo loan for them. Or doing a combination. Remember that HELOC can be used for not only the things that we're talking about bridging the gap, but it also can be used to keep somebody in conventional, but allow them to go up to 90% where they can take a HELOC over the top of it. So it's a vehicle that's used for multiple purposes and to avoid PMI sometimes, right? So that's important. And one of the things I want to talk about, and especially, first-time buyers, even second-time buyers, is, homes are listed at a certain amount. That is not the value of that property, right? The value of the property is what somebody's willing to pay for that home. So the mentality is that I don't want to, overpay over what they're asking. Well, the reality is that there's 25 others that will. So in 6 months, unless you're planning, I'm going to tell everybody on that's listening, if you're planning on selling in a year, don't buy, keep renting. Okay. But if you're planning on holding it, appreciation is a real thing. Just because you're adults now doesn't mean it stops. And, I digress a little bit, but I always use my parents back in the 70s, right? They had a $500 mortgage payment, struggled with it. In 5 years, comfortable. In 10 years, laughable, right? That payment, wouldn't even cover insurance in some communities now. So the thing is that you can't think of a home purchase in today's dollars, right? Because you're getting a fixed rate that stays the same. Your incomes are going to increase. That property value is going to increase. You're paying down principal, separating the two and creating real estate wealth. So when somebody thinks they're paying too much, you're not, because in 6 months, everybody in your neighborhood is going to be happy that you bought at the level you did, because guess what? That's the new value, what you paid for the home, not what they listed it for. And they're going to be using your comp. You're going to get invited to dinner and get a slap on the back from your neighbors because you increased their values. And that's how appreciation happens.
That's a good reason for, a lot of times, maybe some of these buyers, if they think they're going to be in a home for a while, to kind of stretch up into a little bit of a bigger home between the rates being so low and,
Absolutely. And here's another thing that people forget. And some people, again, they don't know what they don't know is, 2 years ago, the greatest, tax savings was home ownership, right? You got to itemize, you get to write off all the interest and all the taxes, or PMI if it's part of it, on yearly off your federal tax returns. Now, the Trump tax rules made it so everyone got a deduction, right? They took your $4,500 and made it $12,500, whereas a couple, $25,000 coming right off your federal tax returns. Well, guess what? The Democrats are going to go back. That's number one on their priority as soon as they get through this pandemic. They're going to go back to the old way. So they're going to reduce that, and renting is just throwing away your money again, right? So someone who's itemizing, you're going to be able to have that benefit, that, whatever that number is, over and above your regular $4,000, which they're going to go back to. I think it was $4,500 the last year that they did it that way. So that's, going to be appealing. So somebody that's in a 30-40% tax bracket, well, you're paying down principal, right? So that money goes back to you on a payment. So when you're trying to compare rent to a mortgage, it's not comparable, right? Because the higher mortgage payment allows you to pay principal down, and you're also getting that tax deduction. So you're getting the government to pay 28, 30, 40% of your mortgage for you. That's a real savings. So when we do comparisons for clients, we really have to take that in account. New buyers, I always tell them to go to their employers and raise their deductions, because, you know, instead of letting the government have a free loan all year, because once you have a home, you're going to have money's coming back to you. So it's it helps them on the weekly and the monthly cash flows. But it's a real savings, and that's probably coming next year. This will be the last year we'll get the $25,000 for couples and $12,500 individuals. I hope that made sense.
It did. It did. So, you know, it just seems there's so much leverage right now that these sellers have. I mean, you know, I talk to a lot of sellers, and I think that sometimes they don't understand like the urgency to put that house on the market. Like right now, you've got the perfect storm.
Mm-hmm.
You know, you really do. You've got great rates. I think that, you know, what do you see happening with the rates, Bob?
Well, rates are going up. There's no doubt about it. We are 0.75% higher and having an awful day again today. And, you know, so just a little history on how rates work, right? Everyone thinks that the Feds left rates alone yesterday, right? Everyone heard that. They left the Fed fund rate alone. That's not what moves rates. The Fed fund rate is what they lend to banks and what banks lend to each other. The prime rate is what banks then, as soon as the Feds move their rates, prime will move from the banks. And that's, they set that rate for, you know, car loans and personal loans and things like that. What moves the mortgage rates is the mortgage-backed securities within the 10-year bond yield. So, and that's institutional players. And once the Feds can kind of control the direction of mortgage rates by words. So our Fed chairman a few weeks ago said inflation's kicking in. It started a little snowball in the mortgage-backed securities market, the bond market, and that accelerated and turned it into a giant avalanche. And it's a self-fulfilling prophecy because once one institutional player, I'm not talking about us as individuals, we're talking about, you know, pension funds and state-held accounts that there's millions and billions of dollars invested. Once they start moving money, everyone follows suit, and that's what we're seeing. So the treasuries are going up in order to attract new investors. The Feds are not going to be buying mortgage-backed securities like they have been doing to suppress rates. And basically we're seeing, you know, that happen. Now the direction's up. Inflation erodes the value of bonds. And, you know, they want to see a little bit of inflation, as the Feds talked about yesterday, because that gets people spending and they need to get this economy going. So they're not going to raise short-term interest rates, but with a few words a few weeks ago, he caused the direction of mortgage rates up, and it's going to continue that way.
So ladies, what are you seeing with your customers? And, you know, and can you see how a product like this how this affects things?
On which product, Deb?
No, I was talking to the girls when they're out there with, you know, buyers and things like that. I mean, what are you hearing lately from your buyers regarding rates and things like that? And can any of these products you think might be able to help?
I would say that with rates, they're not so much concerned. I thought that they would be more concerned, but I really think it's the type of buyer that you're working with. You know, like, are they a first-time buyer? Are, you know, do they currently own a property? Have they done this before? Because the person that already owns something, they know that when they bought before, the rates were much higher than what they are now. So even though everyone's saying they're going up, they're going up, they're going up, they're not. They're still at historic lows. They're not the lowest that we've ever seen, but you're still able to buy more house for less money at the end of the day. And but yeah, I would say I do have a few people that are on the fence, and they're currently in something that they like, but it's not perfect for them, and they're waiting until they find what they want, either hit the market or I find it somehow off market, which is very tough to do in a market where, you know, the seller puts it on and it's just, they could be making upwards from, you know, 100 to 150,000 from what it's listed at.
But that's why it's important to have their pre-approvals updated all the time.
Yes.
All right.
Deb, just briefly, and I digress, and if I talk too much, just stop me. I know everyone else is listening too. So One of the things, and this is my personal opinion, is one of the interesting facts is that a lot of people are in forbearance. And for those of you that don't know what forbearance is, this means they're not making the mortgage payments. Their current servicer allows them to forego making their payments until they're, back employed, or, the COVID ends and we get back to the new normal. Well, guess what? The new normal is not coming back, right? Or the new normal is here to stay. The old normal is not coming back. So the interesting fact for here in Massachusetts is that 90% of the people that are in forbearance have 20% equity in their property. So what that means to me is that when the unemployment runs out in September, because remember they've extended it for these people, and a lot of these people are holding on, hoping to go back to work, right? Well, guess what? My estimate's probably 40% aren't going to be rehired. The corporations are going to wait until they're back into full swing. So as long as it took them to get into this situation, it's probably going to take them that long, if not more, to get out. So when the unemployment ends, these people are not going back to work. And what does that mean? Well, they're not going to do what they did in 2007 and 08, which is give the keys back to the bank, because they have 20% plus equity.
Right.
And what does that mean they're going to do? They're going to list.
They're going to sell.
Yeah, there you go. So it'll be interesting. Now, of course, the government can step in and extend those unemployment benefits again longer. I don't think that'll happen, but it could. But my thought would be, in just thinking about what Mackenzie was just speaking of, it's those people that are waiting, right? Don't wait. Take advantage of the market before it becomes a buyer's market or more level. Get your house on the market, find a place to rent short term, go down the Cape for a few months if you'd like to, and rent a, summer cottage. Get your house on the market.
Well, I mean, Boston, the rentals in Boston, if you ever thought about moving to Boston, you can get unbelievable rates now. My son's renting a place for like $4,000. The same place was renting last year for like $6,000.
Yeah, my daughter is over in South Boston and just got a beautiful place, and they gave her 2 months free. So, people wanted out of the city because of the COVID situation. I think that's probably going to start lessening, right, as we move forward. But, again, a lot of people can't afford rent, and these landlords need to rent the places. So there are discounts and the ability to do short-term rentals. But, I wouldn't wait. If I was selling my property, and even thinking about selling it and buying later, I'd sell it now.
Definitely. I think so. When I talk to people all the time, they're like, well, I want to wait till the pool's open, the flowers are coming out. And I'm like, no. You got a perfect storm right now to sell your property. So, I would, and we have so much coming soon advertising that these people, $145,000 over asking on Monday. It was great. And yeah, it was good.
The other problem we run into now for buyers is that, people are going in with no mortgage contingencies. They're going in with inspections that are for informational purposes only, or for safety, reasons, rightly so. And, and just maybe putting a floor on where that value needs to appraise out on, or waiving their appraised values completely, which is a little tricky for a buyer, because if you don't have that excess cash, right, it would affect your qualifying. That is a little difficult to swallow. So that's when they need to speak with me, and we go over those options and make a good offer that is competing, right? Because, a cash buyer is just as able to default on what they offer. I've seen more cash buyers that default on not being able to perform than I actually do with a certified pre-approval from me, because they think they can do what they can do, and then they find out from their accountant that it's cost them $40,000 to liquidate, or 40% to liquidate a stock, or you can't get at the money that's in that retirement fund. So they turn around and then scramble to try to get a mortgage and maybe don't qualify. So as a listing agent, you have to keep that in the back of your mind and face it, right? Who walks into a closing table with a suitcase full of $100 bills? Nobody.
Yeah,
So
we
what-
just found that out on a property we had in North Reading. It was no home inspection, cash buyer. I saw the proof of funds, the whole thing. And, right before the PNS, he got nervous. But also what I saw on this property that we had this week that went way up and over, I'm seeing pre-approvals for much higher than the offer is. And it was funny because, so we saw offers for like pre-approvals for 1.5, 1.7, and this house was on the market for 929. And the seller really looked at that. They crossed out the finance contingency and they crossed out the appraisal. But the seller really looked at that like they can afford more. They're more of a stable buyer than you would never do that a few years ago. You would do exactly, what you were putting the offer in. So I found that interesting. That
is interesting. My thing is that now putting on my buyer's client hat, right, is that I like to custom my pre-approvals to the exact offer in order so a seller isn't thinking not only, and I understand where they're thinking that maybe they're more qualified, but the offer is the offer. So whether they're qualified for that number or much more, just because it's only at the offer price doesn't mean that they can't afford more, right? My thing is then it just makes the seller want more. And, that doesn't help our buyers when we send something with a wide open number. And to me, it's sort of a lazy loan officer too, because, they gave them something maybe, a month or two ago, or if it's old, I want something that I know my loan officer looked at it that day. Mine are dated the day of the offer, because I want to make sure, rates changed. Rates went up 0.75%. I gave something to someone 6 weeks ago, 8 weeks ago, and maybe they got laid off, or maybe something changed, rates go up, it's no good. And as a agent, I would want to make sure that, it's up to date and real.
Ladies, do you have any more questions for Bob?
Bob, do people come to you about waiving the appraisal too, like in terms of what they have to work with there? Because I feel like waiving the appraisal is the new waive the home inspection. It's like
right.
It's the new hot thing to do.
It is. And it depends on each buyer will be specific, right? So we've won a lot of deals lately, even with 10% down, but we have to be prepared to know that we're already over asking, right? So we can't just tell them it's going to appraise out at what we're offering, because we're over asking price. And even though the property is someone's willing to pay until they close, and that becomes the comp, we have to deal with the comps we have, right? So somebody like that, what we need to do is realize that, look, your first 5% may not go towards a down payment, but we can still proceed because we're at the high balance number. So we just have to put a floor on what we are asking that home to appraise. And what I mean by that, if we're offering 10%, we're 5% over asking price. We're saying, look, we are going to buy it anyway. We just have the appraisal come in at what you did your CMA at. And CMA is a market analysis, right? You gave the comps, you put it on for this price, praise it there, and we'll be willing to pay an extra 5%. That way we can proceed and we can perform. Now, somebody that waives their appraisal, and what happens if the appraisal doesn't even come in at the listing price? They waive their mortgage.
Exactly, and they don't think like that at all. They think that it's automatically going to come in at that listing price, which is not like, I don't think they fully understand how much money this could be costing them, and it's risky.
Yeah, that's right. I just had doctors that kept losing out on homes, and they were putting down 35%, and it was a multi-million-dollar home in Brookline. And I finally just, said to them, I go, guys, it doesn't matter what someone's asking for it. You want it. It's going to be your home, and you're there for 10 years. It's going to be worth $4 million in 10 years. Not, it doesn't matter. So they finally got it because we've lost so many homes, and we waived the appraisal because we don't care. Now, it didn't come in at the asking or the offer price. It didn't come in at the asking price. It was somewhere in between, but it didn't affect these people because they were putting so much down that we weren't concerned with it.
Right, right. Well, any more questions, ladies? We're getting tight.
I just have
Go
one
ahead.
question. I just want you to kind of talk about waiving the financing.
The mortgage contingency.
Just very, very quickly, because I feel like this comes up a lot, and I think we're seeing it a lot more now than we were a few months ago.
Yeah, so that's a great question, right? So it goes back to what a certified pre-approval is. Ravies is a little different than a lot of lenders out there. So we are, we're trained professionals as loan officers, almost like an underwriter. We know all the rules and regulations. So when a client does a pre-approval with me, not only am I just running them through automated underwriting with Fannie Mae and Freddie Mac, but I'm collecting their documents. I'm looking at their tax returns, their W-2s, their pay stubs, their bank statements. We're making sure there's no large deposits. We're looking at their credit. We are looking at that thing through a microscope, and we're making sure our clients are certified. So, I always use that Rocket Mortgage, right? Everyone loves Rocket Mortgage. Yeah, just press here and go. Well, with Rocket Mortgage, the clients in the driver's seat or the rocket ship, and they say, oh, I don't qualify. Well, you know what? My boss is giving me a raise next month. I'm going to just raise my income. Uncle John's going to die. I know he's going to die and he's going to leave me money. I'm going to increase my assets, right? Well, I'm on this, this Credit Karma, and they say my FICO scores are 800. I'm going to just put that in there. Boom, they get a piece of paper. They run out. I'm pre-approved, and you guys take them out, and they really have no money in their pockets, right? And only to find out when they actually apply. So a pre-qual, which is that, and a pre-approval, which is somebody actually at the bank running an automated underwriting, and pulling credit, but they're not looking at their docs, right? So somebody that's, a builder, that's like, I made $1 million last year. When we look at the tax returns and find out that he wrote off $990,000 in business expenses and only made $10,000, and I throw it back to you guys as agents, right? You're 1099 employees. Do you know what you made on your tax returns last year? No, you can't tell me what your net income is. I'm not talking about your gross. You can probably tell me that, but the net is after expenses, and that's what we use. So it's important that we certify these so we know exactly that our clients are really approved. And that makes a huge difference, so we can compete and go out and waive a mortgage contingency if we're comfortable.
But, definitely, like when these 14 offers came in, a lot of mortgage brokers were calling me and trying to look at, I've done this and that and run these people, and if they don't call me, if it's coming down a neck and neck with the offers, if I call somebody that's really never met this buyer, that's just, they got the pre-approval just over the internet, and like you're talking with this example, that's not going to weigh well.
No, it's not.
They won't get their offer accepted. I mean, it really is important more than ever right now.
Right. And not only that, they won't even get a bite of the apple, right? You come in with a pre-qual from Bank of America or Wells Fargo, it goes right into the circular file.
Yeah.
And buyers need to understand that. And what we're doing by waiving mortgage contingencies and we're competing with maybe a cash offer that's probably not really cash anyway, it gives us a bite at the apple, because at the end of the day, it really comes down to dollars and cents, but terms matter too. And it just gives us the opportunity to have our offers looked at in the light.
Yeah, I think that is a really, really good point. I mean, if a buyer said to me, should I cross out the finance contingency? I mean, my first thing was going to be, I think you need to talk to your mortgage broker, because that's something, right. So, but yeah, right. But that's why it's good. Like, you have run so many things on them.
Yes.
that. So it's really, and it's like almost like a commitment letter.
It is. It really is. It's
right.
a certified pre-approval. And once I explain that to a listing agent and we talk about our client, look, the only thing stopping them from coming to the closing tables is if the Eastern Seaboard falls into the Atlantic Ocean, right? Because our clients are solid and we've done all our due diligence. The next step is just immediately to underwriting. we put our stamp on the approval almost immediately. So we have a conditional commitment, and then we go to processing, which is a little different than what banks and mortgage companies do in the real world. That way we know almost immediately that we're set. We're getting a lot of appraisal waivers from Fannie and Freddie. They've been working on building a delta for years and years now. So somebody's putting down 20%, on occasion 10% will get an appraisal waiver. I mean, that eliminates the time contingency needed. So we can do a conventional loan, commitment 21 days, closing in 30 or less if we get an appraisal waiver. And jumbo is usually an extra week to 2. So we really can move through the system quick. Remember, all we do is mortgages. We're not a bank where we're not taking people's CDs and doing car loans, and we just do mortgages, and we do them well.
So we're kind of running out of time here. Ladies, you have any more questions? I'm sure we're going to have Bob back again. I mean, I can think we could be probably talking.
No, that was great.
Love to.
Good. Bob, how do people get hold of you?
So usually through you agents, they can reach out and get me through a referral from you, or my email address is real simple. It's bob.flynn, Flynn, at ravis.com, RAVEIS, spelled a little different. And my cell, which I use 24/7, 508-944-8218. Okay,
perfect. All right, we're probably going to have you back again, Bob, because I'm going to be very interested to see what this forbearance and how this affects the market. And so I'm sure we're going to be chatting again and how these products are working out. I think Ravis is great for putting these things in play right now. I mean, it answers a lot of questions for sellers. So I just want to say thank you so much. And you can get in touch with me at wherehomesgetsold.com. Mackenzie, what's your website?
It's cormierproperties.com.
All right, Nicole?
Yeah, very easy, NicoleLeahy.com.
Okay, all right, perfect. So we're going to be on Facebook Live again in 2 weeks at 1 o'clock, and we hope you tune in. And thank you very much, Bob. Thanks so much. That was
Thank
great
you for having me. Enjoyed it.
Okay, all right. Take care. Thank you.